Hello and welcome to Stockwatch Live. Now they say there's no smoke without fire, but now it seems you don't need smoke to suggest a fire is burning. Tobacco stocks have slumped on news that the US Food and Drug Administration is investigating seizures among e-cigarette users. Shares in Imperial Brands, which posts half-year results on Wednesday, were hit, along with rival British American tobaccos, after the regulator said that since 2010 it had received 35 reports of suspicious seizures. They were mostly experienced by younger vapers, and anyone who has been affected has been urged to report it. There's no doubt that being a so-called sin stock in a climate of growing ethical and sustainable responsibility was always going to make life tough, but electronic cigarettes, which are said to be less harmful than regular cigarettes, has led to the emergence of vaping and been introduced to a whole new generation of tar-free, smoke-free smokers. However, it now looks like vaping, seen as the less harmful alternative to cigarettes, may come with its own unique health risks instead. And this is bad news for the tobacco giants. The golden age of smoking has long gone, with the latest US data showing that sales by volume were down 8.8% in March, marking the sharpest fall in at least 3 years. The question is, have the hopes and profits the likes of Imperial Brands & Co. pinned on vaping now gone up in smoke? Imperial has made no secret of the fact that e-cigarettes were the future. It has already said it expects full-year revenue to come in at or above the upper end of guidance, with growing sales in its vaping division cited as the reason why. First-half earnings will be adversely affected, though, by the reduction of its Logista stake and last year's sale of its other tobacco products business. Shareholders will no doubt want to hear what the investigation into seizures means for its vaping division, myblu, which just days before the FDA investigation was announced, had been described by the company as performing well, with increased investment driving brand awareness with smokers and vapers, and promising significant year-on-year revenue growth. Citigroup seems undeterred. It's upgraded its investment rating on Imperial Brands to buy from neutral and raised its price target from £27 to £30. The shares are currently trading around £24. Now, the telecoms company BT is no stranger to controversy after an accounting scandal at its Italian business. The solution it's opted for is a revamp of its international arm, which means disconnecting 80% of its corporate customers and selling off its local networks. It's currently weighing up bids for its Irish business. The disgraced Italian arm may prove harder to disband. The accounting scandal triggered the exit of senior executives at Global Services and led to a downturn in the wider group's fortunes, which means finding a buy in the midst of all that is proving tricky. There's also the Ofcom investigation that's underway into whether BT discriminated against its rival Air when it won a lucrative public sector deal in Northern Ireland in 2018. And to cap it all, it's being seen as an acid test of the true independence of Openreach, which legally separated from BT last year and is meant to be independent of its parent company's commercial activities. Last year, Ofcom fined BT a record £42 million after complaints about Openreach's behaviour in the past. Add into the mix union action, and the sin stocks like tobacco look a less contentious investment than BT right now. It's due to post its full-year results on Thursday. Prospect, which represents BT's managers and which balloted staff in April on the company's proposed people framework aimed at reducing costs and leading to thousands of jobs being lost. More than 96% voted against it. But despite all that, Goldman Sachs has recently repeated its buy investment rating on BT, but cut its price target 20p to 300p. Back in February, Berenberg downgraded its rating to hold and trimmed its price target to 260p. Sticking with corporate strife, there's a trading update due from SuperDry on Thursday too. Although it will no doubt be hoping that the falling out of co-founder Julian Dunkerton and the company's chairman and chief executive, which ended with Dunkerton rejoining the board and chair Peter Bamford and CEO Ewan Sutherland making a hasty exit, will now leave them to get on with business. Which is of course what it's all about, but also what the increasingly public spat between the three men was also all about. 2 profit warnings in quick succession on the back of an unusually warm summer and autumn, which saw sales of SuperDry's trademark hoodies and coats slump, took the shares down 63% and ended up with SuperDry being demoted from the mid-cap FTSE 250 index at the last review. The dispute centred on the fact that while Mr Dunkerton and his co-founder James Holder argued a back-to-its-roots approach was needed to turn the business around, Bamford and Sutherland were peddling a move away from hoodies and coats and diversification into ski and children's wear. Now Dunkerton is back in the driving seat as interim chief executive. Shareholders will expect him to have something suitably transformative up his sleeve. Straight after the awkward EGM, which saw Dunkerton win the argument with a small majority, Investec resigned as SuperDry's broker and downgraded its investment rating on SuperDry from buy to hold. It also cut its price target by £1 to 500 pence. SuperDry shares, which were trading at just over £15 a year ago, are now around the 525 pence mark. Dunkerton & Co need to turn this fashion retailer's fortunes around fast if that share price is to turn the corner. Finally, keep an eye out for a trading update from Morrisons supermarkets. It's no doubt been keeping an eye on the failed Sainsbury's Asda tie-up. There had been speculation that a series of forced Sainsbury's store disposals could provide ready-made stores in attractive locations down south for Morrisons. With that now off the table, it'll be interesting to hear what Morrisons has up its sleeve. UBS recently repeated its buy rating on Morrisons, but cut its price target from 285 to 260 pence. Bernstein has downgraded its rating to market perform from outperform and cut its price target 40 pence to 240 pence. Deutsche Bank says the shares are a buy but has cut its price target to 235 pence, while Barclays Capital remains underweight and has further trimmed its price target, this time to 205 pence. And that's it for this week. For more on the companies as they report, go to the Markets and Insights section at fidelity.co.uk. See you next time.